The era of blindly buying tech just ended. While most investors are watching their Nvidia gains evaporate in this 2026 rotation, a massive amount of capital is quietly fleeing into a sector that was left for dead. In this video, we are going to look at two energy stocks under $100 that could quietly become some of the most reliable long-term compounders in the market today. By the end of this video, you will understand why these companies have durable competitive advantages and why they could be powerful long-term holdings for investors who want stability, income, and real assets behind their investments. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let us start with the first company. Enterprise Products Partners, ticker symbol EPD. When most investors think about energy stocks, they immediately think about oil prices. If oil rises, the stock goes up. If oil falls, the stock goes down. That is how the market tends to treat the entire sector. But that is not actually how the energy system works. Behind every barrel of oil and every cubic foot of natural gas is a massive network of infrastructure that moves energy from where it is produced to where it is consumed. Pipelines, processing plants, storage facilities, export terminals, and transportation hubs form the backbone of the global energy economy. This infrastructure is essential. Energy cannot move without it. Enterprise Products Partners is one of the companies that owns and operates this backbone. Instead of drilling for oil or speculating on commodity prices, Enterprise operates as what the industry calls a midstream business. That means its core role is transportation and logistics for energy products. Think of it as a toll road system for oil and natural gas. Producers use enterprise pipelines and infrastructure to move their energy products across the country and around the world. In exchange, they pay fees for access to that infrastructure. That simple business model creates something investors love: predictability, because Enterprise earns money based on volume moving through its system rather than the price of oil itself. The company is insulated from much of the volatility that dominates the energy sector. Whether oil is trading at $80 or $60, pipelines still need to move energy, and that means Enterprise still gets paid. This is one of the reasons the company has been able to produce such an extraordinary track record of stability over time. Enterprise Products Partners has increased its distribution for 27 consecutive years. That is nearly as long as the company has been publicly traded. Few companies in the entire energy sector can claim that kind of consistency. Even during periods when oil prices collapsed, when financial crises hit markets, or when geopolitical shocks disrupted the global energy system, Enterprise continued to increase the cash it returned to investors. That track record tells you something important. This is not a cyclical bet. It is an infrastructure business. Another key measure of strength is the company's distributable cash flow coverage. In 2025, Enterprise generated enough cash flow to cover its distribution about 1.7 times. That number matters more than most investors realize. When a company covers its dividend or distribution by that margin, it means the payout is not being stretched. There is a wide margin of safety. Even if volumes fluctuate or markets become difficult, the company still has room to support the distribution. And right now that distribution yields around 5.8%. In a market where many investors chase growth stocks that pay nothing, Enterprise is quietly delivering real cash income backed by real infrastructure assets. That combination is extremely powerful over long periods of time. But the real story here is not just the dividend, it is the scale of the system Enterprise has built. The company controls tens of thousands of miles of pipelines along with storage terminals, natural gas processing facilities, and export infrastructure that connects American energy production to global markets. These assets are not easily replicated. Building new pipeline networks requires massive capital investment, regulatory approval, environmental review, and years of construction. Once the infrastructure is in place, it becomes incredibly difficult for competitors to challenge it. This creates what investors call a moat, a durable competitive advantage that protects the company from competition. For Enterprise, the moat comes from its integrated network. Energy producers prefer to connect to systems that already reach refineries, export terminals, and major demand centers. Once they are connected, switching to a different network becomes complicated and expensive. That creates long-term customer relationships and long-term contracts. Another major growth driver for Enterprise is the continuing expansion of American energy exports. The United States has become one of the world's largest producers of oil and natural gas. As global demand continues to grow, especially in developing economies, the infrastructure required to move that energy to international markets becomes even more valuable. Enterprise owns key export terminals that ship natural gas liquids and other energy products overseas. As global energy demand increases, those export volumes are expected to grow, and every additional barrel that moves through the system generates additional fee-based revenue. This is how infrastructure businesses quietly compound value over time. They grow slowly but steadily as the entire energy system expands around them. Another factor working in Enterprise's favor is the long-term demand outlook for natural gas. Natural gas plays a crucial role in electricity generation, industrial production, and heating. It is also increasingly viewed as a transition fuel as countries attempt to balance energy security with environmental goals. Pipelines that move natural gas are likely to remain essential infrastructure for decades. Enterprise sits directly in the middle of that system, and because the company focuses on transportation rather than production, it does not need to predict energy prices to succeed. It simply needs energy demand to continue existing, which it will. Even as renewable energy expands, the global economy still relies heavily on oil and natural gas for transportation, manufacturing, chemicals, and electricity. This means the infrastructure that moves those resources remains valuable. And when you combine that stability with a nearly 6% yield and a 27-year history of distribution growth, you start to understand why Enterprise Products Partners stands out as one of the most resilient energy investments available today. It is not flashy, it does not dominate financial headlines, but it is quietly one of the most important companies in the North American energy system, and because the stock trades well under $100 per share, it remains accessible even for investors who are starting with smaller amounts of capital. Which brings us to the second company. But before we move on, a quick message from our sponsor. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let us talk about the second company, Total Energy's ticker symbol TTE. If Enterprise represents the infrastructure side of the energy economy, Total Energies represents something very different: scale. Total Energies is one of the largest integrated energy companies in the world. Integrated means the company operates across multiple stages of the energy value chain: upstream production, midstream transportation, downstream refining and distribution, and increasingly electricity generation from renewable sources. This diversification matters more than many investors realize. Energy markets are volatile. Oil prices rise and fall depending on global economic activity, geopolitics, and supply disruptions. But when a company operates across the entire value chain, it can offset weakness in one area with strength in another. If crude prices fall, refining margins may improve. If fossil fuel demand slows, electricity generation from wind and solar may pick up. This ability to balance different parts of the energy ecosystem creates a more stable business model. Total Energies has embraced this approach aggressively. The company has been investing heavily in expanding beyond traditional oil and gas into electricity generation and renewable energy. And this is where the story becomes especially interesting. In 2025, the company's integrated power division accounted for about 12% of its overall business. That may not sound huge at first glance, but it represents a meaningful shift in the company's long-term strategy. Total Energies is positioning itself to operate across the entire future energy system, not just fossil fuels, electricity, renewables, energy storage, global power infrastructure. This hybrid model could allow the company to benefit from both traditional energy demand and the growth of new energy technologies. Investors often frame the energy transition as a battle between old energy and new energy, but companies like Total Energies are demonstrating that the future may be more integrated than that. Oil and gas will remain essential for decades, but electricity demand is also exploding, especially as data centers, electric vehicles, and digital infrastructure consume more power. Companies that can operate across both worlds may have a significant strategic advantage, and Total Energies is building exactly that kind of platform. The company's global footprint is another major strength. Unlike smaller regional energy firms, Total Energies operates across multiple continents with assets in Europe, Africa, the Middle East, and the Americas. This geographic diversification reduces exposure to any single market. It also allows the company to capture growth opportunities wherever energy demand is expanding the fastest. Another factor investors appreciate is the company's income profile. Total Energies currently offers a dividend yield of around 5%. That means investors are getting paid while the company continues to evolve its business model. And because the stock trades well below $100 per share, it remains accessible to a wide range of investors. But perhaps the most compelling aspect of Total Energies is its strategic vision. Rather than resisting the global energy transition, the company is actively participating in it. By investing in wind, solar, and electricity infrastructure alongside traditional energy assets, Total Energies is building a diversified platform that could remain relevant regardless of how the energy landscape evolves. That kind of adaptability is extremely valuable in an industry that is constantly changing, and it is one of the reasons many long-term investors continue to watch this company closely. Now that we have looked at the foundation of both businesses, the next step is understanding why these companies may continue to grow and remain relevant for decades. Many investors underestimate the scale of global energy demand. The world is not becoming less dependent on energy, it is becoming more dependent on it. Every new data center that powers artificial intelligence requires massive amounts of electricity. Every factory producing goods for global trade consumes energy. Every transportation system relies on fuel. Even renewable energy infrastructure requires oil, natural gas, and petrochemicals during manufacturing and construction. Global energy demand is expected to continue rising as population grows and emerging economies expand their industrial capacity. That is the backdrop that makes companies like Enterprise Products Partners, ticker symbol EPD, and Total Energy's ticker symbol TTE so interesting. They are not short-term trades built around market hype. They are positioned directly inside the long-term energy system. Let us start by looking more closely at what could drive growth for Enterprise Products Partners over the next decade. One of the biggest trends shaping the global energy market today is the rise of American energy exports. Over the past 15 years, the United States has transformed itself from a major energy importer into one of the largest exporters of oil, natural gas, and natural gas liquids. Shale production unlocked massive reserves across regions such as the Permian Basin and other energy-producing areas. But producing energy is only the first step. That energy still needs to be transported, stored, processed, and shipped to global markets. This is exactly where Enterprise sits. The company owns pipelines and export infrastructure that connect producers to refineries, petrochemical plants, and international shipping terminals. Every additional barrel that flows through that system generates revenue. And global demand for American energy exports continues to expand. Countries in Europe and Asia are increasingly relying on imported natural gas and other energy products to support their economies. As these markets grow, the value of export infrastructure rises. Enterprise has already positioned itself to capture that opportunity. Its network includes key terminals that allow natural gas liquids and other products to move from inland production regions to coastal export facilities. These assets create an economic engine that can continue running regardless of short-term commodity price swings. Another growth factor for Enterprise Products Partners is petrochemical demand. Many investors focus only on oil and gasoline consumption when they think about energy, but petrochemicals represent an enormous and growing part of the industry. Plastics, synthetic materials, medical equipment, packaging, and industrial components all rely on petrochemical inputs derived from hydrocarbons. Natural gas liquids such as ethane and propane play a major role in this supply chain. Enterprise operates infrastructure that processes and transports these materials to petrochemical producers. As global manufacturing expands, demand for these materials is likely to grow alongside it. This means Enterprise is connected not only to fuel markets but also to the entire industrial production ecosystem. Another advantage that often gets overlooked is balance sheet strength. Energy infrastructure requires enormous capital investment. Companies that build pipelines, storage terminals, and processing facilities must manage large debt loads and long project timelines. Enterprise has historically maintained a disciplined approach to capital allocation. The company generates strong operating cash flow and uses that cash to fund expansions while maintaining healthy financial coverage for its distribution. This financial discipline is one of the reasons the company has been able to sustain its distribution growth for nearly 3 decades. Investors who focus only on price movement sometimes miss this bigger picture. Enterprise is not trying to double its stock price overnight. It is building infrastructure that generates consistent cash flow year after year. For long-term investors, this type of steady compounding can be extremely powerful. Now let us shift back to Total Energy's ticker symbol TTE. If Enterprise represents the physical backbone of the North American energy system, Total Energies represents the global scale of the energy economy. The company operates across dozens of countries and manages a portfolio of energy assets that span the entire supply chain. But the most interesting aspect of Total Energies is how it is positioning itself for the future. Energy companies face a complicated challenge today. The world still needs oil and natural gas. Yet at the same time, governments and industries are pushing toward cleaner energy sources. Some companies have struggled to adapt to this transition. Total Energies has taken a different approach. Instead of abandoning traditional energy, it is building a diversified portfolio that includes both fossil fuels and renewable electricity generation. This strategy could provide multiple revenue streams over time. The company continues to produce oil and natural gas while simultaneously investing in solar power, wind energy, and electricity infrastructure. This dual approach creates optionality. If oil prices remain strong, the upstream production business benefits. If renewable energy continues expanding, the power generation segment grows. Few companies operate across both systems at this scale. Another factor that strengthens the TotalEnergies investment case is the company's global LNG business. Liquefied natural gas has become one of the most important energy commodities in the world. Natural gas can be cooled into liquid form and transported across oceans to regions that lack domestic energy resources. Demand for LNG has surged as countries seek reliable fuel sources that produce lower carbon emissions than coal. TotalEnergies is one of the companies involved in developing and supplying LNG projects worldwide. These projects often operate under long-term contracts which provide predictable revenue streams. For investors, this adds another layer of stability to the business. While oil prices may fluctuate daily, LNG supply agreements often span years or even decades. This long-term structure allows companies like TotalEnergies to plan large infrastructure investments with confidence. Another advantage is geographic diversification. TotalEnergies operates in Europe, Africa, the Middle East, and the Americas. Energy demand patterns vary across regions. When one region experiences slower economic activity, another may be expanding rapidly. This global footprint reduces the company's reliance on any single market. It also allows TotalEnergies to allocate capital toward the most attractive opportunities around the world. For example, the company has been investing heavily in renewable power projects in regions where electricity demand is growing rapidly. At the same time, it continues to develop oil and gas resources in areas with strong energy infrastructure and export capacity. This balanced approach allows the company to adapt as global energy markets evolve. For investors, this adaptability is extremely important. The future energy landscape will likely include multiple sources of power rather than a single dominant technology. Oil, natural gas, solar, wind, and electricity storage will all play roles in meeting global demand. Companies that operate across several of these segments have a better chance of staying relevant over time. TotalEnergies appears to be building exactly that kind of platform. Now let us step back and compare the two companies we have discussed. Enterprise Products. Partners ticker symbol EPD focuses primarily on energy infrastructure within North America. Its strength lies in pipelines, storage facilities, and export terminals that move energy across the continent and into global markets. The company generates stable fee-based revenue and offers a strong distribution supported by consistent cash flow. TotalEnergies ticker symbol TTE operates on a much larger geographic scale. It produces energy, refines it, transports it, and increasingly generates electricity from renewable sources. Its diversified portfolio allows it to participate in multiple segments of the global energy system. Both companies share one key advantage. They provide exposure to real assets that support the global economy. Energy infrastructure and production facilities are not abstract digital platforms. They are physical systems that power industries, transportation networks, and modern life. As long as the world continues to consume energy, these systems will remain essential. For investors looking to deploy smaller amounts of capital, this accessibility matters. Both Enterprise Products Partners and TotalEnergies trade well below $100 per share. That means investors can begin building positions without needing thousands of dollars to get started. More importantly, these are businesses that can continue generating income while investors hold them. Enterprise offers a distribution yield around 5.8%. TotalEnergies offers a dividend yield around 5%. Those payouts allow investors to earn income while waiting for long-term growth to unfold. Income investing has become increasingly important as market volatility rises. High-growth technology stocks often attract attention during bull markets. But when markets become uncertain, companies that generate real cash flow can provide stability. Energy companies with strong infrastructure and diversified operations fall into that category. Of course, every investment carries risks. Energy prices can fluctuate. Regulatory policies can change. Global economic conditions can impact demand. That is why diversification remains essential for any portfolio. But understanding the long-term role these companies play in the global energy system helps investors see beyond short-term market noise. Enterprise Products. Partners in TotalEnergies are not trying to dominate social media headlines. They are building and operating the infrastructure that keeps the global economy running. For investors who focus on durable businesses with real assets, steady cash flow, and long-term relevance, companies like these deserve attention. Now, before we wrap up, there is one more opportunity for investors who want to go deeper into stock analysis. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Before we close, I want to hear your thoughts. Between Enterprise Products Partners ticker symbol EPD and Total Energies ticker symbol TTE, which business do you think has the stronger long-term advantage? Do you prefer the stability of pipeline infrastructure and fee-based income, or the global diversification of a major integrated energy company that is expanding into electricity and renewable power? Share your opinion in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.